You ever wonder how an investor in New York can look at a company in Mumbai and actually understand its financial health? Well, they need to be speaking the same financial language. Today, we're going to dive into India's huge accounting overhaul and its own custom-built language, the Indian Accounting Standards, or Ind AS. Let's get right into it.
So, here's how we'll break it down. We'll start with why we need a global business language, then see how India created its own version. We'll compare the old rules to the new, zoom in on two game-changing updates for leases and revenue, and then wrap up with the big picture implications for businesses across India. Okay, first things first, let's set the stage. We live in a globalized world, right? Money is constantly flowing across borders, and investors, well, they need to be able to trust the numbers they're seeing, no matter where a company is based.
And that brings us to a really fundamental question. How do you make sure that a profit reported in India means the exact same thing as a profit reported in Germany or Brazil? This is the core problem that global accounting standards were created to solve.
The world's answer to that question is something called IFRS, the International Financial Reporting Standards. You can think of it as the financial version of English for the business world. It's all about making company accounts transparent and, maybe most importantly, comparable.
But here's where it gets tricky. A one-size-fits-all approach doesn't always work, does it? So what happens when you try to apply this global template to a really unique and complex economy like India, with its own specific laws and ways of doing business?
And that right there is where Ind AS comes into the picture. It's India's answer to that exact challenge. It's a way to join the global conversation, but on India's own terms.
I love this analogy because it really nails the core idea. Ind AS is not just a simple copy and paste of IFRS. It's much more like a tailored suit. The basic pattern, the design, is global. That's IFRS. But it's been carefully altered and adjusted to fit the specific shape of the Indian economy perfectly.
So how exactly is this suit tailored? It's done in two main ways. First, you have carve-outs. That's where certain IFRS rules are changed or even just removed because they don't quite work for Indian laws. And then you have carve-ins, which are extra rules added into Ind AS to give guidance on situations that are unique to India, things IFRS just doesn't cover.
Now, this wasn't just about getting in line with the rest of the world. It was also a massive shift away from India's older traditional accounting standards, which were known simply as AS.
And who has to wear this new tailored suit? Well, this table makes it super clear. Ind AS is now mandatory for all the big players, every listed company, and the larger unlisted ones. The older, simpler standards? They're still around, but for the smaller, private companies. This slide really gets to the heart of the change. It's a total shift in philosophy. The old system was all about historical cost, meaning what you paid for an asset is what it stays worth on your books pretty much forever. Ind AS brings in this concept of fair value, which means assets are valued at what they're actually worth in the market today. It's a huge move from a static, backward-looking view to a much more dynamic, current one.
Okay, let's zoom in on one of the absolute biggest changes, something that completely rewrote company balance sheets. Lease accounting, all thanks to Ind AS 116.
This quote from the former chairman of the International Accounting Standards Board just says it all. For decades, airlines could lease entire fleets of aircraft. We're talking massive, multi-billion-dollar assets, and they would never even show up on their balance sheets. They were basically invisible obligations.
Ind AS 116 totally fixed this. It introduced this new idea of a right-of-use asset. Basically, if you have the right to use a building, or a fleet of cars, or an airplane for several years, that right is now considered an asset. And of course, the obligation you have to pay for it is now a liability.
So what this means is that almost all leases are now brought on balance sheet. All those hidden obligations are now out in the open for everyone to see, and that dramatically changes how we see a company's assets and, even more importantly, its debt.
And the impact was huge. Just look at this chart from a PwC study. For major Indian companies, this single change bumped up average debt by 7% and the debt-to-equity ratio by a staggering 10%. Now, why does that matter? It means that overnight, companies suddenly looked a lot more leveraged, maybe even riskier. And that could affect everything from their credit ratings to their ability to borrow money in the future. This wasn't just a small accounting tweak, it was a financial earthquake. All right, let's do our second deep dive, revenue. The whole idea of how and when a company can actually say, we've earned this money, was completely rethought under another standard, Ind AS 115. So it moved from a bunch of loose rules to a really strict, principles-based 5-step model. Let's make this real. Imagine you buy a new phone for, say, 50,000 rupees. Step 1 is the contract, you buying the phone. Step 2, you identify all the different things the company promised you, the phone itself, a 1-year warranty, and maybe a free software update later. Step 3, the price is 50,000. Step 4, the company has to split that price between those 3 promises, so maybe 45,000 for the phone, 3 for the warranty, 2 for the update. And finally, step 5, they recognize the 45,000 for the phone right away, but the money for the warranty and update gets recognized over the course of the year. It's just a much more accurate way of showing when value is actually delivered to you.
Now, this had a massive effect on industries with really complex contracts. Think about that telecom company selling you a phone, a data plan, and a free subscription. Under the old rules, they might have booked all that revenue on day one, but with Ind AS 115, nope. They have to carefully spread that revenue out and only recognize it as they deliver each part of the promise. For investors, this gives a much clearer, more honest picture of the company's performance over time, not just a one-day snapshot.
Okay, so let's zoom back out. We've seen the global standards and we've gotten into the nitty-gritty details. But what does all of this really mean for corporate India?
Well, there are definitely clear trade-offs. On the one hand, getting in line with global standards really boosts investor confidence. It makes it easier to attract foreign money. But on the other hand, those carve-outs we talked about mean you still can't do a perfect apples-to-apples comparison with a global competitor. And let's not forget the cost of compliance, upgrading systems, training people. That's been huge, and it's hit smaller companies the hardest. It's a classic balancing act, really.
So, here's the bottom line. Ind AS is way more than just some boring accounting update. It's a really strategic decision by India to plug itself into the global economy, but to do it while making sure the rules still work for its own unique economic realities. It's all about finding that balance.
And all of this leaves us with a really big question. In a world that's pushing for universal standards in everything, how much room should there really be for local flavor? Is the end goal perfect global uniformity? Or is a tailored, locally relevant approach actually the better way to go? Can you really have the best of both worlds?